To give us a feel of the markets going into 2016, we're joined by Wong Weiyi, General Manager at online unit trust distributor Fundsupermart Malaysia. Now, it seems that you're going to be taking on a de-risking position going into next year. Flesh that out for us.
I think, when we look at GDP growth globally, it's not really very strong yet. US is recovering, of course, but the rest of the markets, like emerging economies, because of the commodities prices that came down so much, what we see is that next year is expected to pick up, but if commodity prices stay so low, chances are we get to see revision to the downside for global economic growth.
Stabilization in commodity prices next year?
We hope that it is going to stabilize. I mean, recently we've seen that the oil prices has fallen even more, and of course we have record inventories for a lot of commodities. So that is going to add some pressure down on commodities prices next year. And of course, if we look at Fed raising rates next year and how fast are they going to raise it next year, that is going to have an impact on US dollar. And US dollar, if it strengthens even more, then you can see further downward impact on commodity prices.
All right, so given these themes in the commodity space, the Fed as well, how is this affecting your outlook on the equity side, specifically local stocks?
I think for the local stock side, if we look at the GDP growth also, of course we always assess from the top-down approach. The GDP growth numbers look a bit slower in 2016 compared to 2015. I think the reasons are quite obvious. On the consumption side, we have cost increases in almost everything, toll, cigarettes, public transport, etc. So that is weighing down on consumption expenditure. And if we look at government spending, because of the oil revenue coming down so much, I think in the previous budget, they were forecasting about $48 per barrel. Mm-hmm. And what we are seeing now is closer to $40 per barrel. That will have another implication on the ability of the government to spend to boost out the economy. So the only good thing is that we hope that exports continue to do very well, and that will be some mitigating factor for our economic growth. So with that aspect, that's the economic outlook that we have for Malaysia.
So do you see private spending then picking up the pace?
Yes, we have seen that coming up. Industrial production is of course, with the exports doing better. I guess there will be more investments by the private companies to boost up their manufacturing capacity, etc., to benefit or take advantage of this weak ringgit now, which makes them much more competitive than the neighbors in the region. So we see that to pick up along with exports. So that will mitigate some of the impact that we have in the slowdown in consumption, inability of the government to spend so much.
Yeah, but there's still some serious major overhangs when it comes to Malaysian assets. So kind of balance out then, your holdings between equity, or your calls rather, for the equity space and the fixed income space, and how are you balancing those out?
I think for a long time, even globally, we have called for 7 years, we called for overweights in equities. I think this year, 2016, is going to be quite tough. We actually advise clients to move back to neutral on equities and versus bonds. So the position we are taking is that given the earnings opportunities, earnings growth, the potential returns that we can expect from markets is going to be lesser compared to the past few years. And that's why we probably may not want to take so much risk, put them in the bonds asset class. Yeah.
But you're not saying embrace wholeheartedly the fixed income space. So what kind of allocation are you seeing here?
For example, for balanced investors, when we say about overweight, we have been advocating them to do a 60-40% allocation, right? 60% to equities. So this time around, we're pulling back by about 10%, 50-50, we'll go back to a neutral position. Within the bond space, it's not all bonds that investors should go after, right?
So what should they be looking at?
We are looking at high-yield bonds. Because high-yield bonds throughout the year, they are still the yield has even gone up quite a fair bit. So in this case, I think that given the recovery in the US, where we have a lot of US high-yield bonds, and the yields now at 8+%, right? So it's something very attractive, and it's worthwhile risk for us to take. On the shorter end and the safer bonds, then of course it will be more affected by the rate hikes decision.
Any particular sector then with the high-yield space?
High-yield space, I think in broad, we lump them, we see them as a group. But of course, if you are willing to take some risk, I think the energy sector is something that you can look at. But just a small position if you are looking at a rebound, because I mean, how much more can oil prices fall? The other part that we really like would be the Chinese developers. Mm-hmm. We see that there is a pickup bottoming in the property prices, seems to be picking up, activities going on. And from there, the yields are still quite attractive. Some of the names in the Chinese developer side, we're still getting about close to 10% double-digit yields. So it's a risk that we think is worthwhile taking.
Now, I mean, you ask how low can oil prices go? Ask Venezuela, they're saying $20 a barrel. So it remains to be seen. Now, speaking about commodities, I mean, you have mentioned your outlook for several regions, but what about Australia? Given the jobs data that they just posted, are we seeing a rebound there?
I think for a lot of the countries where your currencies have fallen so much, I think you will expect to be, some foreign investors coming up to pick up some properties. You expect a huge gain in tourism. I think, the job gains that we have seen probably attributed to the pickup in the tourism activities, etc. Whether it is sustainable over time, I mean, the country is still quite dependent on commodities prices. So if tourism is going to pick up, it can be sustained, then it will be good. But for now, we are just more focused on the Asian economies where we see better chance of earnings rebound.
All right, next time you're in, you got to tell us more about why you prefer Japan. But thank you so much, Weiyi, for joining us
My pleasure.
today. That was Wong Weiyi, General Manager at Fundsupermart Malaysia.